As real estate professionals, we get asked all the time, after selling my house, will I have to pay capital gains tax with the money I netted? Well, the answer solidly is it depends. Let's dive into the details. Hi, I'm Kay Wright from the Wright Choice with that properties, Christie's International Real Estate. First off, is your home sale taxable? The IRS allows single filers to exclude up to $250,000 of capital gains, and for married couples filing jointly, it's up to $500,000. But here's the catch. In order to qualify for these exclusions, you must meet certain criteria. You must have owned the home for at least 2 of the past 5 years, used it as your primary residence for the same duration, and haven't claimed the exclusion in the 2 years preceding the sale. Let's take a look at some examples. Example 1, meets exclusion criteria, married filing jointly. Let's say that you're selling the home you've owned and been living in for the past few years, and that you are married and you file taxes jointly. In that case, you would qualify for a $500,000 exclusion on the sale of your home. Since you are netting $400,000, which is less than the exclusion, you would not have to pay any capital gains tax on those proceeds. Example 2, meets exclusion criteria, single. Let's assume the same situation as above, except that in this scenario, you are single instead of married filing jointly. In that case, you would qualify for an exclusion, but it would only be $250,000. With $400,000 in net proceeds, that means that the $150,000 would be subject to capital gains tax. The question is at what rate those proceeds would be taxed. Let's assume that you would fall in the 15% bracket. Multiplying $150,000 by 15%, you would have to pay $22,500 in taxes, leaving you with a total net proceeds of $377,500. Of course, you may be subject to state income tax as well, which would increase the amount you have to pay. Example 3, does not meet exclusion criteria. If you don't meet the exclusion criteria, then the entire $400,000 would be taxed as capital gains. In that case, the first big question is whether those gains are taxed as short-term or long-term capital gains. If you have owned the home for 1 year or less, your proceeds would be taxed as short-term capital gains, which means they would be subject to the same tax rates as ordinary income. It is always best to consult with your tax advisor. There are exceptions to the general rules laid out above, but for the most part, it comes down to whether you've owned and lived in the home for 2 of the past 5 years. If so, you will qualify for a significant exclusion. If not, you will have to pay capital gains tax on the entire amount. Bottom line, figuring capital gains tax may be owed on a home sale depends on several factors. One is whether you meet the criteria for excluding $250,000 for single filers and $500,000 for couples filing jointly. A second factor is how long you have lived in the house and whether it has been your primary residence. In addition, you must not have claimed the exclusion in the 2 years previous to the home sale. If you meet these criteria, you're in luck. But if not, you'll have to pay capital gains tax on the entire amount. For personalized tax advice, consider consulting with a financial advisor. Selling your home is a big step, but with the right knowledge, you can navigate the tax landscape with confidence. This is Kay Wright with that properties, Christie's International Real Estate, and we are the right choice for all your real estate needs.